Imagine this. You're scrolling through the news and suddenly you see a headline. Startup X valued at 10,000 crores after Series D round. Or maybe you read about an early investor in Flipkart, Ola, or Zomato who turned a few lakhs into crores. And you think to yourself, why do only VCs and big investors get access to these opportunities? Is there a way for someone like me, a retail investor, to participate in the venture capital game? That's exactly what we'll explore today. Can retail investors invest in VC funds? If not directly, what are the real, practical options available in India? And most importantly, what should you expect in terms of returns, risks, and the right mindset before you even consider it? Now, the truth is, traditional venture capital funds are not designed for retail investors. They cater to what's called accredited investors, or high net worth individuals. Typically, the minimum ticket size runs into crores. 1 to 5 crores in India is quite normal, and once you commit, your money is locked away for 7 to 10 years. No exits, no liquidity, no quick redemption. That's why most retail investors are shut out. But that doesn't mean you have no entry point. The landscape in India has started to open up, and today there are several platforms and structures that allow ordinary investors to get a taste of venture investing. Let me take you through these step by step. The first gateway is angel investing platforms. Think of names like LetsVenture, WeFounderCircle, or Tyke Invest. These platforms act as a bridge between startups and small investors. Instead of committing crores, you might be able to start with as little as 50,000 rupees, sometimes even lower in special deals. You pool your money with other investors, and together you back promising early-stage startups. It feels like being part of a mini VC fund, except you're choosing specific startups yourself. The advantage is obvious. You can start small and get hands-on exposure. The disadvantage? The risk is sky high. Most early-stage startups fail, and you could lose your entire investment. But on the flip side, the one that works can multiply your capital several times over. The second path is Category II Alternative Investment Funds, or AIFs. These are SEBI-regulated vehicles that pool money from multiple investors and then deploy that into startups. Unlike angel platforms, here you're not picking individual startups. You're backing a professional fund manager who makes those decisions. The catch is the minimum investment. In India, SEBI mandates that you need to put in at least 1 crore rupees to participate. Still out of reach for most retail investors, but far more accessible than the 100 crore checks traditional VCs expect. Then there's an interesting hybrid: venture debt funds and certain mutual fund-like products. Venture debt funds lend money to startups rather than taking pure equity, which means returns are steadier, though capped, and the risk is somewhat lower compared to pure VC equity. This space is still young in India, but it's growing fast because it gives investors a way to balance high-growth exposure with some level of downside protection. Another clever way to get exposure is through listed companies that behave like venture investors. Take InfoEdge, for example. Best known for Naukri.com, but also one of the earliest investors in Zomato and Policy Bazaar. By simply buying shares of InfoEdge on the stock market, you indirectly own a slice of their VC-style portfolio. Similarly, companies like Reliance or Tata have started backing startups. Internationally, you have giants like SoftBank and Prosus, both listed companies that are effectively venture investors at scale. For a retail investor, this is the simplest, most liquid way to gain exposure to startups without the complications of private markets. And finally, there's the pre-IPO and unlisted shares market. Platforms now allow you to buy equity in late-stage startups like Ola, Swiggy, or Byju's before they list publicly. The ticket size is usually lower than an AIF, often in the range of a few lakhs, and the companies are more mature than seed-stage startups. But here too, liquidity is tricky, and you're betting on the IPO or acquisition actually happening. Now let's talk about returns and risks. This is where many retail investors get carried away. The headlines you see about 10x or 100x returns are real, but they are the exceptions, not the rule. In venture capital, 9 out of 10 startups typically fail or give mediocre returns. 1 or 2 winners pay for the entire portfolio. That means if you're putting money into just 1 or 2 startups, your chance of losing everything is very high. The only way to manage this risk is through diversification, spreading your investment across 10, 20, maybe even 30 startups. That way, even if most fail, the one or two that succeed could make your portfolio profitable. Another way to manage risk is to balance your portfolio. Don't treat startup investing as your core wealth-building strategy. Think of it as your high-risk, high-reward satellite allocation, maybe 5 to 10% of your total investable wealth. The rest should still be in diversified, liquid, and safer assets like equities, debt, and real estate. And let's set expectations clearly. Unlike mutual funds or stock trading, there is no steady compounding in venture capital. You won't see monthly returns or even yearly returns. You might wait 5, 7, or even 10 years before you see a meaningful exit. When it comes, it could be massive. But until then, patience and discipline are the name of the game. So to circle back to the question, can retail investors invest in VC funds? Directly, no, but indirectly, through angel platforms, AIFs, venture debt funds, listed VC-style companies, and pre-IPO shares. The doors are slowly opening. The minimum investment ranges from 50,000 rupees on the lower end to 1 crore and above on the higher end. The pros are obvious: access to India's innovation story, the thrill of backing the next unicorn, and potentially life-changing returns. The cons are equally stark: high failure rates, illiquidity, long lock-ins, and the real possibility of losing your entire capital. The story of venture capital is not about quick riches. It's about patient, high-risk bets that sometimes turn into legendary outcomes. If you understand that and you enter with the right expectations, even as a retail investor, you can now play a small part in India's startup journey. And who knows, the startup you back today might just be tomorrow's Flipkart or Zomato.